Weak rupee, strong debate. Is Sanjeev Sanyal right? Or does research say something else? Just imagine. You wake up in the morning, open your phone, and a headline flashes. The rupee falls again, hits a new low against the dollar. A slight anxiety sets in. Your mind immediately runs toward petrol, gas, inflation, EMIs, and foreign investment. But in the middle of all this, a top economist comes forward and says, I am not worried about the weakness of the rupee at all. This is where the story becomes interesting. Because while the common citizen is anxious, people connected to the country's economic policy are saying, don't worry. The question is a weak rupee really nothing to fear? Or are we ignoring a bigger risk? It is worth noting that this statement by Sanjeev Sanyal, a member of the Prime Minister's Economic Advisory Council, has come at a time when the rupee appears to be slipping rapidly. Moving from around 1991 per dollar within just a few days is, in itself, a significant move. Usually, such a fall is linked to economic weakness, capital outflows, or macroeconomic stress. But Sanyal's argument turns this entire debate on its head. According to him, during periods of high growth, a weaker currency is not unusual. Sometimes it is even strategic. This may sound strange at first, but if we peel back the layers of history, the picture becomes clearer. Sanyal cited the examples of Japan and China. When Japan was growing rapidly in the 1960 and 1970, its currency was deliberately kept weak. Similarly, China kept the yuan controlled and undervalued for a long time during the 1990s and 2000s, so that its exports remained cheap and its factories became globally competitive. In other words, a weak currency is not always a sign of crisis. Sometimes it is part of a growth strategy. But this is where the second debate begins. India today is neither China of the 1990s nor Japan of the 1970s. The structure of India's economy is different. Our import-export pattern is different. In many areas, Indian industry is still heavily dependent on imports, especially in electronics, machinery, semiconductors, chemicals, and petroleum products. In such a situation, the question arises, if the rupee weakens, will exports really benefit? Or will expensive imports wipe out those gains? This is where the voice of research enters the picture. Several recent studies have shown that the benefits of a weaker rupee are no longer as straightforward as they once seemed. In theory, we are taught that a weaker currency makes exports cheaper, boosts orders, and improves the trade balance. But in practice, the picture is far more complex. Many of India's export sectors depend heavily on imported raw materials and components. When the rupee falls, the cost of these inputs rises, which limits the overall benefit to exports. Take electronics as an example. India wants to become a major exporter of mobile phones and electronic goods. But for these products, many components, such as chips, displays, and batteries, are imported. When the rupee weakens, the prices of these components go up. As a result, much of the export price advantage gets wiped out. The same pattern can be seen in chemicals, machinery, and petroleum-based products. Some research also suggests that the impact of a weaker rupee is uneven. Food and agriculture-based exports may benefit a bit more because their dependence on imports is lower. But overall, in a country like India, currency depreciation does not magically improve the trade balance. In many cases, the import bill rises so much that the trade deficit actually widens. That is why some economists argue that the rupee does not work like a shock absorber for India. In other words, when there is a global shock, the idea that the currency can fall and absorb the impact does not fully work in India's case. This is because the structure of imports is such that price effects show up very quickly. However, Sanjeev Sanyal emphasizes that, for now, the weakness of the rupee has not led to a rise in domestic inflation, and that is the most important point. Inflation is the real test. If the rupee falls and petrol, diesel, food, medicines, and daily essentials all become more expensive, then it turns into a direct crisis for the common person. But if inflation remains under control, the fall in the currency can be treated as just a numbers game. So far, this is exactly what India is seeing. Oil prices have not surged sharply, and food inflation is also manageable. That is why policymakers do not appear to be panicking. Now it is important to understand another angle: capital flows. One major reason for the rupee's depreciation this year has been the outflow of foreign capital. When foreign investors pull money out of Indian markets, demand for dollars rises, putting pressure on the rupee. But this does not necessarily mean a loss of confidence in India's economy. Many times, such outflows are driven by global factors, such as interest rates in the US, bond yields there, or sudden opportunities emerging in other parts of the world. Many global brokerages and analysts believe that the rupee is now largely undervalued. In other words, most of the expected decline has already played out. They point to strong foreign exchange reserves, a manageable current account deficit, and stable macroeconomic fundamentals. This means that even though the rupee appears weak, the system has enough strength to manage it. Foreign exchange reserves are a key part of this story. When a country has adequate dollar reserves, it can intervene in the market whenever needed. This helps prevent excessive volatility in the currency. Over the past decade, India has built significant strength on this front. That is why, even though the rupee's movement looks weak, it does not appear out of control. So the question arises, should we really not worry at all about a weak rupee? The answer is not that simple. In the short term, if inflation is under control and financial stability is intact, there is no need to panic. But in the long term, if the currency keeps weakening continuously, it can raise some structural questions. For example, is our manufacturing strong enough? Are we able to reduce import dependence? Are we increasing high-value exports? In reality, a weak rupee is a symptom, not the disease. The disease would be if growth slows down, inflation rises, investment stalls, and employment is hit. India is not in that situation right now. But it is also true that completely dismissing the weakness of the rupee by saying it doesn't matter at all would not be right either. It is a signal that needs to be understood. There is also a psychological aspect to this entire debate. A currency often reflects confidence. When people see the rupee falling, they assume the economy is weakening, even if the data says otherwise. That is why statements by policymakers become so important. They're not dealing only with numbers, but also with emotions. The real meaning of Sanjeev Sanyal's argument is probably this: we should not take decisions in panic. Treating every fall as a crisis is just as dangerous as ignoring every fall altogether. Balance is essential. Learning from history is important, but understanding today's economic structure is even more important. Today, India is in a transition phase. We want to boost exports, but at the same time become self-reliant. We want to be part of global supply chains while also protecting domestic industry. In such a situation, the role of the currency also changes. It is no longer just a tool of trade. It becomes part of a strategic balance.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources: news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.